Hey guys, it's May from Markets with May, and this is part 2 of how to look at bank earnings season. So it's really important to understand that the financials in general are a precursor to everything that is needed if you are going to come out of a recession or otherwise grow this economy. That's because everything takes money. And so you're watching very carefully for all the different little pieces and nuances that these big cap companies can tell you. Now, in part 1 of this series, we went through how the mega cap financials make money. We have a lot of banks reporting earnings on Friday the 13th, right into a holiday weekend. So it will be an exciting time in the marketplace. We've got JP Morgan, Bank of America, Citi, Wells Fargo, and then BlackRock, not a bank, an asset manager, reporting. And they will give us lots of intelligence on a host of economic concerns and considerations that people have had for 2023. Now, some of my longtime listeners and supporters know I personally listened to and reviewed the documents for about 400 companies out of the 500 companies in the S&P 500, and I do it systematically every quarter and have been for quite some time. And what I'm always listening for is what one company is saying that might give me insight into the broader macroeconomic picture or what's going on in general in the industry or what's going on at one of their competitors. Now, while there are a few companies that report before these big cap financials do, the cluster of what's going on usually happens all at once and sets the tone for pretty much everything to come for the next quarter. Now, this video is going to be more or less divided into 2 parts. First, I'm going to talk about the 4 areas of finance that I discussed in the previous episode and what I get in the way of economic data from each. In the second part, I'm going to talk about generalized macro comments that I'm looking for and watching out for as I listen to the investor relations folks ask their questions. Before we get into that, the disclosures: past performance is not indicative of future returns. This is not investment advice. This is for education purposes only. I definitely have both long and short investments across the financial services space. Finally, a shout out to Gurula.app. Money goes where it's treated best. And if you'd like more details about them, have a look at my show notes. Let's get into the macroeconomic data that I'm pulling out of the financials earnings reports. Now, first, we're going to go through the various divisions of these big cap companies and what they have to tell as relates to economic information. Now, in the previous episode, I talk about roughly 4 areas that big cap financials make money and how they do that. In this episode, I am going to break it into kind of 2 pieces. I'm going to put the asset managers and capital markets pieces together, and then I'm going to put the investment banking, commercial banking together, because they are actually more or less separated in that way. Now, the asset management and capital markets portion of the call and the questions associated with it give you a sense for who invested in what and which asset classes did really well or were particularly relevant. So let's break that down a little bit. In asset management, they oftentimes tell you what asset classes were preferred over others. For example, if there's a lot more movement of capital from equity to debt, then that tells you what's going on there. And then the capital markets piece will tell you if there's even any debt for them to buy. The equity capital markets is really putting everything into growth mode when it comes out of its trough, and understanding what parts are still able to get financing through equity versus which ones have to use debt versus which ones can't get financing at all from the asset management and the capital markets piece is really, really good intelligence to understand what would then happen to all the companies coming out of earnings season. Now, capital markets is really going to tell you about what's going on in corporate America, especially in the biggest companies they're in. And asset management is going to tell you if people have just given up on companies altogether and going into other asset classes, or they're doing more like government bonds and things like that. So you really are listening to all of it to understand how is money flowing through the system, or is it just not flowing through the system? Is it contracting out of the system? Now, we also talk about that a little bit more when I talk about investment banking and commercial banking, but the big blowups that might happen from the prime brokerage business in particular, or on bad trades that just somehow netted out poorly, are going to come from this division as well. But they will coincide with the banking, investment banking stuff that I'm about to tell you. You'll also get some information on any big mistakes that happened, like in Archegos, and what kind of pressure might then exist systemically for the financial markets to open up to. you'll want to watch for that, because those types of risk mishaps can put massive pressure on the marketplace, because it means that those that would be most able to help on expansion might not be able to do that activity. Now you can see some of this in its negative format in Credit Suisse. I did a video reviewing their last quarter. They've got a lot of interesting things on the asset management side, particularly in high net worth, that speak to the different pieces of this. They also put capital markets in their investment banking division. That's very common. That's very normal. And they speak to that in their earnings call as well. So if that's something you want to review and understand, have a look at that video, review the earnings call, and hopefully that will help. Now, investment banking and commercial banking are going to give you a sense for what's happening when people go to get financing. So in some cases, they just won't go at all, and that'll show off very clearly in investment banking and in commercial banking. In other cases, they'll only be able to get debt, they'll only be able to get equity, and then anything in between that. Sometimes they'll also tell you which industries are excited and don't care where interest rates are. They just want the money right this minute. There's all kinds of stuff that give you the nature of what specifically the corporate world is looking for. In investment banking, it's always going to be really the corporate side of things. Now, the commercial banks are going to show you a lot in the way of who precisely is asking for money. But in particular, the granularity with the commercial banks report really next level. They will tell you the geography that they're in and what they're experiencing. They'll tell you what kind of loss rates are going on and whether or not there's a bigger problem within mortgages, auto, student lending. Some of them do have governmental pieces that they'll talk to you about. But really, given that we are concerned about employment and we are concerned about whether or not the consumer can hang in there, the commercial banks are really going to be the first to give us some sentiment on it. Now, the commercial banking information also gives you a highlight to the consumer credit companies that come out a little bit later the following week. And that's going to be American Express, Visa, MasterCard. Those are all payment processors. That's not for this episode. But essentially, between all of it, you'll get a good picture for what people are spending on. Who is it? Is it business expense or is it personal expense? And are they paying their bills or not? Now, this is going to be the fourth quarter. And so if we're starting to see distress, it's going to carry through to other places in the marketplace, not the least of which is retail, which makes a lot of its money during that holiday season. It also will be relevant to what the retail companies are going to take on as strategy for the full year as they manage through whatever it is going on with consumers and their ability to pay for stuff. Now, definitely the banks themselves, even if they're not seeing losses, will give you insight into where they're willing to make more loans and where they are not. So sometimes it can be like, we're not going to make a lot of housing loans. We did not grow the book of business in housing. We're not going to grow the autos lending piece. We're not going to make that type of loan. They might also say stuff like, we're going to decrease the size of our exposure to subprime, meaning even though banks typically have a smaller amount that they lend to people with low credit ratings, it's going to get even worse. Dependent on the bank, sometimes they'll also give you some information on the age demographic that they're seeing and what the different credit losses look like across that age demographic. Now, you're going to get a whole lot more from the consumer finance folks, those credit card related companies, in the following week, but they kind of start to give you a picture for the types of questions that are going to be relevant going forward. Now, because it turns out that the banks all have footprints in different parts of the world's geography, you also get a really good sense for what's going on across the world, even if you're just looking at the US components of it. You know, JP Morgan, Bank of America, and all are primarily in the United States. Their footprint overseas is not very big. Citibank has been unwinding all the pieces of their business overseas, but still has far more significant exposure to Asia, Europe, and Latin America. Goldman Sachs, Morgan Stanley, they have different exposures to different parts of the world. I'm not going to go through it, but they'll also be able to tell you where they're still getting banking business versus where it's more or less closed down, given what the macro pictures look like. Finally, in all cases, it's really the commercial bank piece that drives the fact that all of the investment banks have to report this thing called CET capital ratios. That essentially is going to be monitored by the Fed. And it really is, what exactly is it that you're holding in the bank to make sure that we don't have any major issue if there was a banking failure. we're going to understand what ratio the banks are holding. Did they increase it or decrease it? And they'll also tell you why they increased it or decreased it. Now let's talk about other macroeconomic data that comes out of the banks. Now, if you think about it, all that research that comes out on CNBC or otherwise comes out of these big financial services companies, whether they be investment bank or more of a multi-line like Citibank, JP Morgan, Bank of America, Wells Fargo, that sort of thing. And of course, all that brain power that's inside the bank and given to investors is also used internally. As such, the bank's overall strategy tells you the strongest opinion at the bank as relates to how they're setting up for 2023. For example, if you'd listened to the earnings call for UBS last quarter, you would have heard him talk about the idea that he felt that China was going to reopen after the Chinese elections. And that has started to play out, although it may not be in the tempo that he specifically was thinking about. Additionally, some of them might talk about the overall state of health of the industry. And in that regard, they might give you some insight into where people are looking for hedging. And that really is another word for saying insurance. So they're worried about something and they're going to the investment bank to try to help out there. They might also tell you things that they're reserving against. Given what's been happening recently, I'm sure they'll talk about their particular feelings about crypto and what they're seeing. It's just a lot of little random gem drops that happen either as a course of them describing their commercial strategy for the year, or alternatively, an analyst asking a question and you getting insight from the CEO of these big, amazing companies that have massive amounts of resources. Now, since one of their biggest costs is labor costs, and there have been a bunch of layoffs announced first thing this year, we know that it's going to be a huge component of the Q&A portion and what that implies as relates to the health of different parts of their business. For better or for worse, valuation on companies is 100% based on whether or not they can grow. And when you lay off a bunch of people, you're going to have a specific strategy in mind. So those questions are absolutely going to be fair game this quarter to give us a sense for the macroeconomic picture in financing, which means it's going to tell us what they're seeing as relates to demand for financing and the growth of other companies. Well, that's all I have for this episode. If you enjoyed that, please do like, share, comment, or subscribe to my channel. And part 3 is going to be a reactionary video to this piece from Yahoo Finance. So I'm going to go through and to show you a different way to listen to what it is they are providing in the way of information. Alternatively, if you didn't get the first video, here's a link to that video. And it would be wonderful if you would subscribe to my channel here.